Hey guys, it's Shelly. So I just wanted to come up here and give a little bit of information about one of the most common goals that my clients set or my clients say they want to set when they get started with me, which is buying a home in the near future, right? So everybody wants to buy a home, and a lot of times the main services that I provide for that is credit counseling, and financial coaching, right? So I just wanted to kind of share what the major things that I'm looking for or focusing on for my clients when I'm going through that process for getting a home. So let's say buying a home. So right outside of the basic, budgeting and making sure you're stable and making sure that you're in a habit of saving and building the savings, there are three major, I would say, debt related or credit related factors that I'm focusing on. So the first thing is your credit score, obviously, right? So there's pretty much three things with the credit score that's important that impacts your lending, right? Lending for a home. And the first thing is that your credit score affects your interest rate. Actually, before that, your credit score affects you just qualifying in general. For a lot of different lending, and especially conventional lending, there are minimum scores. So let's say in general, 620 and above for a certain type of lending, or even for some, it's like 580 and above. Now, it doesn't mean you can't qualify, and I'll get to that a little bit later. But in general, there are pretty much minimum scores where right off the bat, if you're over that, okay, you can move to the next step. So qualifying, your credit score can qualify you for a mortgage. The next thing is that, and probably one of the biggest things that people want to focus on is the interest rate, right? So to lower your credit score, the lower your credit score, the higher your interest rate, obviously, right? So if you are, let's say, if the qualifying rate or the qualifying score is 620, cool, you got 620, but guess what? You're probably going to get the worst interest rates that they have to offer if you're in that lower range of your credit score. And then the other thing that your credit score affects is your down payment. Now, you remember when I said that depending on your minimum credit score requirement, you could qualify, you couldn't qualify a loan, but there were exceptions. So a lot of times those exceptions is, oh yeah, I'll accept this lower credit score and I'll qualify you for a mortgage, but guess what? You need to make a higher down payment. And still in those situations, a lot of times, majority of the times, you're still going to get that higher interest rate. But they're saying, okay, I'll deal with your bad credit. I'll qualify you. You can get this terrible interest rate. But just make sure that we're gonna pay a higher down payment just so we can feel a little bit more safe. So that's the major things that we're thinking about and educating you on and preparing you for as far as your credit score. So the idea is obviously to help you increase your credit score as much as you can before you get to the lending process. That way you can get the best rate. That way you can hopefully qualify for the best terms as far as a lower down payment if you wanted that or whatever. And then also just making sure you can qualify in general. The next thing that we want to focus on is actually, and it sounds the same, but it's not, but it's your credit history. Now, why do I say credit history? We already talked about credit score. Well, your credit history is going to show, it's pretty much the big picture of everything. It's your report card, right? So your credit score is your GPA, your credit history, your credit report is your report card for your adulting life as far as debt goes and payments go. So what we're looking for in your credit history is to make sure that you don't have recent late payments, recent judgments, recent collections. And by recent, lenders most of the time are going to look in detail to the last 2 years of your credit history. Now, does that mean if you have anything negative in the last 2 years, you're automatically declined? No. But it just means that will be something that you might have to work through as far as the lending process. And for me, my idea with credit counseling for you is to make sure that you've been able to communicate with your debtors as much as possible. We've been able to work a situation out that we can get the best information reporting on your credit as possible, negotiating terms with creditors and debtors and collection agencies and all that good jazz. So in general, we're going to be educating you on that and preparing you for that process. Usually they're going to be looking at detail the last 2 years, but obviously anything negative on your report will be up there for up to 7 years. So 2 years and 7 years of credit history will be getting looked at. The more recent, the worse. And a lot of times with that credit history, they're definitely looking for anything housing related. So missed payments with a prior mortgage recently, or missed payments with rent that was reported as over 30 days late, or whatever it is. will be important. So housing related credit history is super, super important. Okay, so we have your credit score, we have your credit history, and then the major thing that I like to focus on is what I call, or what everybody calls, the ratios, right? So if you remember math, you understand kind of ratios is comparing two different things, right? And it's usually expressed as a percentage. So the two main ratios that we're focused on as far as lending is your income ratio, and I'll say housing to income ratio, and your debt to income ratio, or your debt ratio. So as far as your housing income ratio and your debt to income ratio, a lot of where people go wrong when they're calculating this on their own is that they just consider, oh, my debt to income ratio, I'll just calculate my current debt. Or my housing to income ratio, I'll calculate it based off my current housing. But no, it's based off the projected or your hopeful mortgage, right? So PITI, principal, interest, taxes, and insurance for your housing to income. The idea is conventionally, and the minimum is pretty much like, or the maximum is pretty much for conventional mortgages is 28%. So they don't want to see that you're spending more than 28% of your total gross income, so your pre-tax income, on housing based off the projected housing payment that you're trying to qualify for. So let's say you're trying to qualify for $100,000 house and the mortgage is like $500 or something like that. They don't want you, what is that? A little over $2,000 or something. They don't want you spending more than 28% of whatever that pre-tax income is based on the projected housing. And then the next thing is debt to income. So conventionally, it's about 36%. And so when we're talking about debt, like I said, we're talking about that prospective mortgage. We're talking about credit card minimum payments, loan minimum payments as far as personal loans, student loans, auto loans, child support payments, all of that totaled up and divided by your total amount of pre-tax income. And that will get you the ratio. And the idea is to have both that debt to income ratio below 36% and then your housing to income ratio below 28%. So I would say that these are the general numbers and based off of conventional lending, but there are different programs. You got USDA, you got FHA, you got the VA loans, and all of those have other, I would say, more lenient requirements. So I always try to gear up and plan for trying to get my clients to reach these numbers, but you could probably go up to like, I think it's maybe 31 to 33%. I'll say 31 to be safe on the housing, or 43%. You could still might be able to qualify for a different mortgage program or whatever. So having 43% debt to income, all your total debts plus your projected mortgage divided by your total pre-tax income. So yeah, those are the major things that I will be focused on with you as far as getting you ready for a house. So make sure your credit score is as high as we can get it, and making sure your credit history is, complete, is showing a full picture, and that we remedy as much of that as we can of the negative stuff that's in your past. And then your ratios, making sure that whatever house, let's say you have an idea of having a $200,000 house, we need to be focused on the income. We need to be focused on your other debts. Making sure that all of those ratios add up to what they're supposed to be. This is a little bit long-winded, but I hope you learned something. And if you have any other questions about qualifying for a mortgage, as far as your credit, as far as just getting your finances in order in general, definitely reach out and we can talk about it. And thank you for watching this far.